Hello, everyone, and welcome to another episode of Unscripted Equity Curiosity. My name is Ami Joseph, and I'm the sector head for technology here at Hedgeye. With me today, we've got Andrew Freedman, the sector head for communications, internet, and media, and we have the sector head for China, Felix Wang, also with us today. And Unscripted Equity Curiosity is a free Hedgeye podcast. This is where Andrew and Felix and I get together and shoot the breeze and discuss different things happening thematically, sometimes single stock, sometimes macro. And often enough, we have a guest, sometimes from Hedgeye, sometimes from outside Hedgeye, that we've had over the last 2.5 seasons. We're 2.5 seasons in, so this is season 3, episode 14. And today, we're in the midst of earnings. So today is a Thursday, and you guys are all going to get this on Saturday, so apologize for the delay, but we're in the midst of earnings. And we're kicking back ideas about reading the tea leaves in terms of business economics, leading and lagging. Andrew has had some interesting things to say about the ad market on the morning call and indicators there in terms of strengthening. So we're going to talk about pace with Andrew. Felix is in an alternate universe where the Fed for Felix is going the opposite direction of our Fed, is easing, and where stocks are at lows or near lows, near like all-time lows. So let's get, and I obviously have lots to share about software as well. So let's get after it. I guess Andrew, we're going to start with you because you made some comments this morning that got my brain moving. And there was a period where ads got overbought, and then there was a pullback and ads got underbought. And it seems now that ads are getting bought again. And I guess my question is, do you think this is the beginning of a new cycle, or just a few easy comps and then you got to watch out and run the other way? How does it make you think about the advertising market? And do you, a long time ago, you and I talked about, all three of us talked about changes in the ad market where, the legacy TV, radio, et cetera, print, were all on their way out and getting disrupted by digital. Is that share gain still happening in the digital area against those, or is that kind of like stabilized out and it's just growing now, kind of like with overall growth of the industry? Kind of like there's a big meatball of questions in there, but take it however direction you want to take it.
Yeah. No, thanks, Ami. Look, I think as far as the ad market goes, there's so many different components. So maybe first focusing on kind of the digital advertising landscape. Meta, Google dominate that. They have, well over 90% market share between the two of them. And, it's interesting, right? Because I get this question. I always get asked the question of how does digital advertising kind of line up with the overall economy and demand drivers? And, I think it's important to put, everything that's happened after COVID kind of in its own bucket versus everything pre-COVID, because these stocks are very rate of change based, and budgets and advertising spend is inherently, reflexive or pro-cyclical or however you want to describe it, right? And it's all about demand, especially for direct response, which is, I'm spending $1 on Meta or Google and trying to get $2 or $3 in return. And so we spent last year slowing rapidly, more so than I think anyone had expected, for sure. Even though we were bearish, I would definitely, go as far as say that estimates ultimately came in a lot more than I had anticipated. But when you're going through that slowing process, the first thing that brands do is they cut spend, right? It's for digital advertising, especially because it's easy to turn off. It's not contractual. You just basically tap your performance marketer on the shoulder and say, hey, we need to cut by XYZ%. And that's what happened last year. And almost all the time, ad budgets get overdone and they get cut too much, right? They get ratcheted up too high, they overshoot and they undershoot. And so when you're going through that reflexive process of budget reductions last year, by the time we got to the end of last year, we saw budgets just absolutely get wiped out. People are cutting experimental budgets. They're cutting anything discretionary. And what does that mean? That means that they're cutting too much beyond whatever the natural rate of demand is. And so going into this year, what we've seen is that demand trends stabilized. They haven't gotten incredibly, they haven't reaccelerated massively. But when you think about demand trends, when I say demand trends, I mean like e-commerce revenue is like probably the biggest, or direct-to-consumer revenue is probably the biggest, most important factor to watch for digital ads. It kind of bottomed out in the middle of last year, and it slowly started to get better, and budgets continue to get cut over that period. And so we're in this period of time going into this year where things have not deteriorated meaningfully relative to that point in time. And as a result, companies are starting to invest a little bit more, right? So, you can't cut below zero. But let's say you were at, 150% before, then you cut all the way to 25%. Maybe now you're saying, okay, everything's better or stabilizing. We're going to go from 25% back to 50%, right? And that process of going from 25 to 50% after you've gone from 150% to 25% is your positive revision cycle, and it's a rate of change inflection. Of course, right? The demand trends need to continue, right? We can get back up to 75%, but eventually, if you're going to get back up to 100%, meaning your 1-to-1 ratio of demand, then at some point you're going to need to see end market trends continue to accelerate in order for people to really start to pour money back in and see the growth sustain itself. So that's the market we've been in for most of 23 has been this ad recovery, and digital takes market share in that. Direct response is the first to recover, being Meta and Google. Brand advertising can lag. Brand advertising typically lags direct response. So for like a Roku that's going to report earnings after the close, while the comps are really easy, they're not going to be seeing as much strength, right, as a Meta or Google is at the moment. But they should be doing better because of the comps, and they should be taking market share. So, because CTV is also digital. So that's kind of at a very high level, what's going on right now is that things are improving, and then we just need to see trends continue to move in a certain direction for it to sustain. But like I have data that looks really positive, right? That suggests that we're getting kind of very far into this recovery phase, and so we'll see how it continues to play out. Felix, you got
Hey, Andrew, that's really helpful. I'm just curious, just from my own space, sort of in Asia, did Meta or Google mention sort of advertising trends in Asia Pacific? I'm just curious.
So everything's accelerating. What's been really fascinating, especially for Meta, has been Temu. And a lot of these Chinese-based e-commerce platforms that are trying to grow outside China. And so with China reopening, they've come online, and they're basically doing the TikTok playbook, but e-commerce. It's really interesting, right? Because how, during the pandemic, part of the reason why TikTok scaled so aggressively was they spent a ton of money on Facebook, Instagram, Snapchat advertising. Now what we're seeing is that like Temu, and was it Shine? I'm pronouncing that correctly.
Shein. Yeah.
Shein. Yeah. They are also spending. So you have these platforms that are advertising very aggressively on Meta, and it's been a big boost to their revenue growth rate this year. Now we'll have to see if it's how sustainable that is. A lot of it is a market function of just the marketplace was what have you shut down, right? So it's not like that money's going to go away next year, but it is something that they've called out as being a positive driver to their growth rate this year.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
That's really interesting that Meta would mention Temu.
Well, they didn't mention it. They didn't mention it specific. They didn't.
Okay.
Right. Like so everyone thinks it's Temu because they're specific. They're saying that it's, China-based e-commerce companies that are primarily targeting consumers outside of China, right? So you can probably go down the list of companies, and then if you actually look at some of the ad impression data, you'll notice that Temu has popped up this year as one of the number one ads that have been trending across the entire platform. And then you kind of list, from the conversations with the performance marketers, are definitely seeing and hearing, especially in the younger demographic, teens and, young Gen Z, that, Shein and Temu are definitely starting to, make some inroads. So that's, I don't know if that's helpful, but that's kind of what we're seeing, or I'm seeing.
No, that's super helpful because I'm seeing something similar. I just wasn't sure if U.S. companies have mentioned this sort of ad. It's not really, it is. It's basically an advertising battle between Shein, Temu, and then Alibaba through AliExpress and Lazada. They also want to get involved, and as well as TikTok, obviously. So it's interesting to see the dynamics there between all these big players. Some more new disruptors, some more, old disruptors like TikTok, all trying to get as much mind share from the consumer as possible, and that includes the U.S. market. So that really jives with what I'm seeing as well. So I appreciate that comment.
Oh, so Andrew, it's the end of July. You've got strong data, and we're in the third quarter. What do you think happens next? Do you think we continue from 50 to 75 to 100 to 125, like a normal cycle over the next, what do you think that is, 3 years, 3 quarters? What's the...
I mean, right now, if we stay on this trajectory, right, big if, but based off of everything where we are today, it's going to be probably over the next 12 to 18 months. If demand trends continue to hold up through Q4, then budgets are going that are already kind of out there are going to be set for next year. That's going to start to see money filter in through the rest of the advertising ecosystem, right? So that's Roku, that's Pinterest, eventually Snapchat, maybe, but that's kind of the play, right? And then you'll start to see independent publishers start to continue to take market share back, money start to really filter through everywhere else, and that would be actually more of a sign of probably the end of it. I think that's kind of, I mean, the comps next year are just, especially in the first half, are really, really easy for a lot of these more traditional media cyclicals. And even for the more experimental, speculative pockets of the ad market, they get more difficult, even for Google, in Q1 specifically, but Meta generally, starts to see more difficult comparisons. So, there's going to continue to be divergences underneath the hood. Things are not great, but they're not getting worse, and they're getting better. And that's typically positive for, multiples and stock prices, after where estimates have been. But we'll see what happens.
Yeah, it's interesting. It's if we do this 6-quarter thing through to the 100+% zone, yeah, it definitely means we're in a like normal widening beginning of a cycle type of situation.
I mean, look, like Meta and Google, like, for as bearish as we were last year on digital advertising and the media segment, it hurt how bearish we were. And where things were trending last year were really bad for 2023 estimates, which is why coming into the year, Meta 2023 earnings numbers were $8, right? They're going to do almost double that. So the thing is that I'm going to continue to track it, but the reality is that nobody has any fucking idea. It's a part, just to be very frank, like anyone that's sitting there that says that they think they know with confidence is lying to you. Like they don't, and you just have, because the companies don't know, right? Meta didn't know that they were going to put up and guide to a 20% revenue growth quarter in Q3 60 days ago, right? And so I think you just have to take it every single, step, day by day, because these decisions get made incrementally, right? Oh, guess what? We had a better quarter than expected. Okay, that's great. Things look better for Q3. We have more budget. Okay, well, we don't want to spend it just yet. We're still nervous. Wow, 60 days later, things are still okay. Well, now we're going to Q4. Demand looks like it's holding in there. Let's maybe start spending more money on advertising. That's how that works. And that's a very simple example, but that's how it happens on a macro basis for advertising decision making. CPG companies are coming back online. They're spending more money. Because guess what? Like Procter & Gamble beat earnings. Their stock price is out after they've had supply chain issues. So now they're going back into investment mode because they're worried that they don't want to take price again, and they have to drive volume growth. So it's all it all builds on each other, and it's just, you just have to watch it. I mean, it's because it can turn very violently, very quickly, as we've seen. But yeah, I mean, we were bullish on Meta since the beginning of the year, but if you told me that they were going to do, $15 in earnings this year, I would have laughed at you.
Right.
But as the data continued to get better and we were just tracking and tracking and tracking, that's just kind of what happened. Google too. So, both those companies, Ami, like they're going to, and I mentioned this on the call this morning, like they're pacing, especially after the cost cuts too, right? So like their expense structures are radically more efficient and lower. And so now you're like looking at these companies and you're like, yeah, like revenue growth is reaccelerating. And oh, by the way, on a lower OpEx means that they're going to get back to like 2021 levels of earnings probably this year, actually exceed that, right? Which, stock prices typically follow the earnings trajectory. So, why can't Meta and Google stock prices hit all-time highs? Especially if this continues into 2024 and they manage their expense structure appropriately, because then people start underwriting 24 into 25 into 26. 25 or 24 could be a disaster. Like it totally could. But all that matters is like the current, right? And how you're pacing and relative to historical trends. And so far it's been pretty positive. So, it's ruthlessly data dependent, ruthlessly mentally flexible. Like just, I don't know anything, right? All I know is what the data and the process is telling me. And I'm just going to listen to that and make decisions accordingly. And that's kind of how I've been approaching the ad market and trying to think like, a little bit further ahead because these turns can happen very quickly and people need time to do the work and blah, 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 blah.
Okay, last question for you before I shift over to Felix, is to what extent are the beer wars having any impact on advertising this year, good or bad? And then second of all, how are you thinking about the political ad spending climate that's ahead in the next 12 months? Like, is that at all accurate to things?
Political is going to help local more than it's going to help national. It's definitely going to help support growth. It's not always a game changer. Like, it's going to help broadcast media. iHeart Radio, for example, is going to do a lot better because of that. That's going to be a boost to them. And then, I'm sorry, the question before the political one was,
beer wars.
Oh, beer wars. I mean, look, when they have to spend more in marketing to try to support the brand, right? Like, that's just it's a casualty, but then, they have to figure it out, it's one component of a larger market, like beverage. But like, Coke is doing better. Speak with Pelosi quite, enough where I kind of have an idea of like where he's at. And he's like, oh yeah, I definitely, like, in my space, CPG companies are going to be spending more this year than last year. And CPG is like the largest category for Meta, but also for, digital and CTV and things like Roku and stuff. So, willing to take some pain in the near term, right? Because I think there's a lot of opportunity out there to kind of wait for the turn, because I think it's coming, it's already come for like direct response, but, something like a Warner Brothers or something like a Roku, I think it's, by the time we're in Q4, I think it's going to be more evident. And then really kind of going into next year is going to be the play here, I think. But we'll see.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40-plus equity analysts discuss key market developments, trends, and our high-conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
Awesome. Pretty interesting. The data dependency is interesting. The flip is bad to good is interesting. And the trajectory obviously is very interesting. Felix, you're in a totally different world right now. You've got a government that's trying to make growth reaccelerate. So they're lowering interest rates and doing all kinds of things. Are you still, it seems like from our conversation before, you seem like you're still a China bull. Tell me about what makes you bullish on China right now. Tell me about some of the weaker, like I know that there was some headlines, maybe I didn't catch it correctly, but like, if there was weaker data, tell me about that. Tell me about the delta between kind of like what everybody else sees and what you see right now, because it seems pretty extreme.
Yeah, I mean, extreme is the perfect word to characterize how everybody's thinking about China right now. If you look at my long-short position monitor, that's kind of how I feel about China. It's not, at the beginning of June, I was pretty much all long, very few short. Now I'm still predominantly long, but I added a few short ideas ahead of earnings season, just because earnings season probably is going to be another choppy one. Our macro team is kind of negative on China Q3. So we're not quite there yet on a major, I would say, long-term bullish pivot on China. But I would say we're getting pretty close. And the reason I say that is a couple of things. If you look at the China Golden Dragon Index, the NASDAQ China Golden Dragon Index, which is one I look at, it's still up 23% since my capitulation call on June 1st. So that means there hasn't, even though there's been so much negativity on China, everybody avoiding China, we still haven't been going down. And the Politburo earlier this week offered a lot of support, at least through words, or no restrictive words, if you will, if you look at the property market. So they're trying to help, right? And them trying to help rather than to restrict the economy is always a good thing. So maybe no bad news is actually good news for the stocks. And I also think it's, it is a wrong picture to think that China is in a dumpster that just caught on fire and the fire just won't go out. I think there are also some green shoots in the economy that very few people are talking about, which is why, my long ideas are kind of pivoted towards those areas. But they're trying, is what I'm trying to say. Is, right now sentiment is so extreme on the negative side. A lot of the fund managers want to pivot elsewhere in Asia Pacific, but I generally think, with the government trying to generate more support, we'll see what they do on the stimulus side. That's what everybody's focused on. But at least they're slowly changing some of the policies out there. That's gonna, if you want to, for example, buy a home these days in China, it's becoming easier now. So they're trying to get the consumer to spend. This is different from the U.S., in which particular parts of the consumer economy is very strong. It's what I've heard when I have my meetings in Asia. But trying is the word, Ami. But generally, I remain optimistic.
So when you when you roll this all up and you're optimistic, what areas of the economy do you think have the most upside in the next, 6 to 12 months or whatever timeline you prefer? Is it construction? Is it online? Is it, hardware? Is it finance? Is it education? Like housing? What consumer? What are the areas where you think, what you're optimistic and people just don't see it and it's going to come?
Well, I've been pitching a lot on the tourism side, but tourism also has been choppy outside of China. I would say domestic travel is more resilient than overseas travel, and that's mostly because of the visa restrictions and other factors at play, like hot weather and so to speak, making people rethink their decisions to travel outside. So I generally am positive on tourism. I'm also positive on education. I've talked about education many times just because people have to go to school, no more COVID, lockdowns and so forth. And then there's one new area I'm looking into where I think, at least right now, people see some green shoots, but they're not overly exuberant on it. And, the last couple of months, despite consumer spending in China being weaker than expected, this new sector did phenomenally well. And I was surprised to myself. So I'm doing some research on that end. But, as I explained earlier, I'm not there yet where I can say China, all of the boats are going to get lifted. I think it could come sooner than a lot of the pessimists out there, but we're not there yet. I'm hoping soon enough, but we have to see a recovery in the consumer first. That's, to me, top of mind. Everything else is secondary.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
What is the stimulus that people are looking for? Like, what level are people looking for that would catalyze like the next step? Like, what is that? What's the good level of stimulus? What's the bad? What's not enough, and all that kind of stuff?
Yeah. So basically, what can you do to get consumer to spend again? That to me is the critical question. The other critical question is, what can you do to stop youth unemployment from going up? Right. And that's more of talking to the private enterprises. This is why, earlier last week, it was a big meeting. It was a big policy report basically saying we're going to support all the private enterprises and so forth. So that was a major positive step in terms of, oh, hey, you know what? We bombed you guys for 2 years with regulations and stuff. That led to enormous restructuring, which means layoffs. Okay, we can't do that anymore because all these college graduates don't have jobs to find because, we punished all these private enterprises, which led to a lot of restructuring layoffs. So the government kind of shut their own foot, so to speak, and they're trying to reverse that, right? Because they're seeing the damage it's causing to the real economy. So they're gonna have to figure out what to do on that front, and to let particularly the internet giants feel more comfortable to rehire again, to grow again, to reinvest in that entrepreneurial spirit that led China in a mega growth phase for a couple of decades. That's what they have to show. And I think it comes through policy, it comes through tax breaks, it comes through consumption stimulus, it comes through basically vouching for anybody to hire somebody these days, which is not easy to do in a, still a choppy macro economy. So the policymakers, they have their hands full on this, Ami. But they're trying. The world is trying. They know the dire circumstance that China is in, even though COVID is lifted and reopened, and China's reopened. So to me, that's a positive. That means they're not ignoring the issue. They're trying their best to resolve the issue. Now the question is, can they do it? That's the big question, right? And so the market is speculating on this at the moment.
It's too bad there's this trade war stupidity, because with China's massive amount of unemployment, it's a well-trained, well-educated, labor class that foreign companies would have been excited to hire and take advantage of. And, for example, Zoom was built entirely with Chinese R&D in the beginning. I know eventually that ran into they had some controversy around that, and they had to make some changes, but the company was able to scale very fast and very inexpensively to build like a really great product and kind of take over the world. Too bad for that. I hope you're right. I hope that the people will find jobs. That's probably the number one most important thing for driving the economy forward and fixing some of the things that potentially are holding China back.
Actually, I have a question for you, Ami,
sure.
on that topic. Are you hearing from your, at least in the software space, semiconductor space, maybe, how's the perception of trying to do business in China? I'm talking about from a hiring perspective. Are they trying to expand into China if they haven't been, or if they're already in China? Are they backing out of China, or are they still in China but expanding? Are you hearing any chatter on that from your companies?
I mean, Apple continues to be like an anomaly in the sense that full steam ahead. But everybody else is sort of cautious, that worried about revenue exposure, worried about supply chain exposure, worried about increasing trade war issues and having to debook revenues from China and not allowed to ship there and sell there. So there's definitely more of the cautious side at play for most of the companies at this point. And I would say my guess would be that it'll be hard to convince most of the technology universe to hire right now and build out divisions and segments in China, I think, today. It would really have to be someone who has more long-term comfort with that rather than like a Western company.
Yeah, I mean, I hope that perception changes, right? I mean, obviously, it's a lot of politics behind it, but if China does turn around in the second half of this year, maybe there will be a lot more interest because to me, politics is politics, but at the end of the day, you got to show the growth potential, right? So if China's booming, everything's through the roof in terms of growth, a lot of multinational companies definitely would be excited. But right now, that's not really the case, right? So that's why maybe there's more hesitant in terms of business strategy here.
Yeah, I think so. All right, well, that wraps up our time today for Unscripted Equity Curiosity. This has been a good one. Great to hear from you, Felix. Great to learn from you, Andrew. For both of you guys, I hope the rest of earnings season is smooth and successful. And for those listening, I hope that you've had a chance to listen and learn from some of the tea leaves on the macro front that some of us are thinking about in tippy toes of the cycle, and kind of like as we go here through the first month of the third quarter and see how the rest of the year looks. Thanks again, and we'll see you next time on Unscripted Equity Curiosity.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.